Welcome to Kenton Teaches. Enjoy the video.
You start by locking down essentials. Confirm margin, account permissions, and your maximum risk per trade. Once done, scan for liquid underlying assets and focus on options 30 to 60 days out. This balances time decay and theta. Next, size your position using a fixed percentage of capital and define risk with predefined stops or defined risk spreads. Make the first small entry now to test execution and order routing, so you know fills and slippage before scaling. Now refine the trade structure and management. You pick the strategy that matches your market bias, credit spreads or iron condors for range, long calls / puts for directional moves. Then optimize strikes by delta and implied volatility exposure. For directional entries, aim for delta between 0, 15 and 0, 35 to balance cost and probability. Once live, place one cancels other orders and plan scaling. Reduce exposure in 25 to 50%. Finish by executing exits and consolidating lessons. You define profit targets and time-based exits up front. For example, realize gains at 50 to 75% of max theoretical profit, or reduce size as expiry nears. Once done, close or roll positions that breach your loss threshold and lock profits progressively. If something goes wrong, such as repeated bad fills, widen your spread by 0.5 to 1 point or cut size immediately. Then document the cause and adjust routing or strategy to prevent recurrence.
Thanks for watching. Please subscribe if this video was helpful.